Okay, I'm preaching to, the most dedicated of us all here, that 20 to 25 points of governmental not-for-profit. So those two areas together, I want you to cling to those two areas for some good solid points that are going to help you towards your 75. Okay. And so I want to go ahead though and spend a little bit of time with the discussion of the government-wide financial statements. And as I've said, the information that's in here is probably going to constitute about 5 of those, 20 to 25 points. Okay, so we've covered the major bulk here, but I just don't want to completely ignore the information that's here. Okay, so let's just go ahead and remind ourselves that when we have our fund financial statements, we have the governmental funds, we have the proprietary funds. How do you spell proprietary? I don't know. And you have fiduciary funds. Okay, and remember that we had the 5 grass funds, the C, and then we had the KIPDO, whatever, the 4 fiduciary funds. Now, what we're going to focus on here in F10 now are the government-wide statements. And remember, we said that with the government-wide statements, we'll do what? We will basically sit here and pick up the proprietary funds and consolidate them, not the proprietary, but the governmental and the proprietary funds, and consolidate them at the government-wide level. Now, when we look at the government-wide level, we'll see that there will be government activities, and there will be business activities. And depending on the nature, it might not be surprising that the governmental funds will go into the governmental fund category. We do take the internal service fund and include it with the governmental activities. That's because the internal service fund, they service mainly the other governmental funds. For business type activities, we put those under, for our enterprise funds, we put those under business activities. And we're going to see that the fiduciary funds are not consolidated up at the government-wide level. Okay, so that's really where our focus is going to be, is understanding the form and content of the government-wide statements, which we haven't really focused on previously, and then the relationship between the fund financial statements that we've been studying all this time and the government-wide statements. Okay, now when you take a look, we tell you that when we look at the government-wide statements, okay, we have an operational accountability focus. When we look at our fund financial statements, in particular the governmental fund financial statements, our focus on fiscal accountability. Is the money being spent for the intended purpose? We set up funds to make sure that, if we have a special revenue fund that's set aside for road improvement or tax and gas, that special revenue from the gas tax is actually being used for road improvement. We talked about that some time back. Now, when we look at the basic reporting model, okay, and this is the GASB basic reporting model, okay, GASB, Governmental Accounting Standards Board, basic reporting model. Okay, when we look at that, we will see a management discussion and analysis. Now, next to that, I want you to put RSI. Okay, that is required supplemental information. Okay, now notice we have another section that's also called required supplemental information. The MD&A is also required supplemental information, but they want that to come first before the financial statements. The second thing you see are the financial statements, and the third thing you would see is additional required supplemental information other than the MD&A. Now, when you look at this middle box, the middle box is called the basic, and FS is financial statements. Notice we have the government-wide statements, we have the fund financial statements, and the notes there too. Okay. Now, when you look at this model, notice everything on here is what? Everything on here is either the basic financial statements or the required supplemental information. So if something is required, what does that mean? Not a trick question.
It has to be included in the report.
You have to provide it. It's required. And if it says supplemental, that means it supplements something else. Well, the only thing up here is what? The basic financial statements. So these required supplemental information, although they're not financial statements, they are financial in nature. So even the MD&A, which we'll talk about later, is talking about what? Financial aspects of this government operations. The MD&A isn't saying, what a beautiful city we have. Look at City Hall. What a skyline. No, it's talking about what? Accounting financial information. Okay. Now, you see this little arrow that goes back and forth. And in this little arrow, they're calling this the integrated approach. What this arrow is representing is that we are going to have to provide a way to show the relationship between the fund financial statements and the government-wide statements. So let's just use an example. Let's say I buy a piece of equipment, and I buy a piece of equipment for $1,000, and I buy that out of the general fund. Now, if I buy that out of the general fund, say I had cash of 1,000, I have, say, fund balance of 1,000, and then I go ahead and I buy equipment for $1,000. What journal entry should I make for the purchase of that equipment?
Capital expenditure.
Good. I'm going to debit expenditure for $1,000. I'm going to credit cash for 1,000, right? Good. Now, of course, I will go through my closing entries, and when I close my entries, I will close my expenses to my fund balance, right? So at the end of the year, how much cash am I going to have? That's the only transaction that happens for the entire year.
0.
Cash is 0. I close my expenditures to what? Fund balance. So I would credit expenditure, debit fund balance. So fund balance is also what? 0 now. There's my general fund balance sheet. Okay, good. Now, what happens? If I need to report this transaction at the government-wide level, and I'm using full accrual accounting, so at the government-wide level, I would start out with what? I would start out with cash of 1,000. And we call the equity what? We call the equity net position. So my net position is what? Is 1,000 as well, right? Okay. So then I go ahead and I buy this piece of equipment. And if I'm at the government-wide level and I'm using full accrual accounting, what journal entry should I make to purchase the equipment?
Equipment debit 1,000 and cash debit 1,000.
Good, because I'm using full accrual accounting, I will book the long-term asset equipment, and I'll credit cash, right? For the 1,000. So what happens when I go ahead and I look at my government-wide statements now? The cash is now 0, but now I have equipment of what?
$2,000.
Well, where would we get $2,000 from?
Oh, sorry, 1.
I have equipment of 1,000. Good. Okay, my net position is still 1,000, right?
Mm-hmm.
Okay. Now, when someone picks up, when someone picks up these this set of financial statements, these basic financial statements, they'd say, well, I don't understand how you have fund balance of 0 at the fund level. Meanwhile, you have net position of 1,000 at the government-wide level. So what we would need to do is provide a reconciliation. Okay, the integrated approach requires a reconciliation of the fund financial statements to the government-wide statements. Okay, and so what happens? That's the integrated approach, and this reconciliation would start with fund balance, and the fund balance is going to be what? 0. And then it would show capital asset, and it probably would have more words than that. It would have something highfalutin like capital assets are not reported at the fund level under modified accrual accounting, but they would be reported under full accrual accounting at the government-wide level, something like that. You know, government accountants get paid by the word, but the ultimate effect would be that they would go ahead and do what? Add the capital asset of 1,000, the equipment of 1,000, and then they would show net position, and the net position would show 1,000. Does the thing reconcile? So now someone can understand the cause of the difference between the fund balance and the net position. Okay, now let's say that I had borrowed $500 to purchase. Let's say I had long-term debt of $500. If I had long-term debt of $500, would I report that at the fund level? Long-term debt. Say I had long-term debt of 500. Would I report that at the fund level?
I don't think you do you?
No, there are no
A long-term anything, right?
no long-term items. Good. Okay. But would that be reported at the government-wide level?
Yes.
Yeah, under full accrual accounting, I would have, say, long-term debt of $500, right? Okay. So now when I report my net position at the assuming I still have that equipment of $500, when I report my net position at the government-wide level, how much would the net position be?
500?
Now it's going to be 500, right? Net position plus liabilities equal assets, right? Okay. And then on the reconciliation, I would report long-term debt of 500. That would be subtract, and the thing would reconcile to the $500, wouldn't it? Okay. So that is how that reconciliation is going to work. We're going to see that there are two reconciliations. One is going to reconcile the balance sheet like we just did. The other is going to reconcile the operating statements. I'm just going to put income statement out of laziness. We don't call it the income statement, but we'll reconcile the balance sheet. We'll reconcile the income statement. Now, this is the only time tonight you're going to feel it necessary to use a calculator, at least for this part of our discussion tonight. Everything else is a listing of details that fall under this model right here. Okay, and the only time you need to use a calculator is when we start talking about you know, the reconciliation. The other time you'll need to use a calculator is when we talk about major funds, but we'll get into that a little bit later. Don't worry about that right now. Okay, so this stuff is not hard. It's a sort of, you know, listing of what needs to be reported at the government-wide level under this basic reporting model. Okay, question. All right, good. So let's go ahead and let's take a look. And here we go now, giving you more detail. We have what? We have the MD&A. MD&A, as we've already seen, is required supplemental information. We have the government-wide statements. One is called Statement of Net Position. The other is called Statement of Activities. We have the fund financial statements, and we have them for our governmental funds. And all of our governmental funds, we saw in some of our other discussions, have a balance sheet and a statement of revenues, expenditures, and changes in fund balance. Our proprietary funds have statement of net position, which is like the balance sheet, statement of revenues, expenses, and changes in fund net position, which is like the income statement. And remember, proprietary funds are the only funds that prepare the statement of cash flows. And then we have our fiduciary funds. Our fiduciary funds prepare a statement of fiduciary net position and a statement of changes in fiduciary net position. And then you have the notes there too. Now, what I want you to do is go ahead and draw a bracket from here all the way down to the notes. And how should I label that bracket? That bracket is what?
That's the basic financial.
Good. That's the basic financial statements, right? Okay. The other thing I want you to do is to flashcard the names of the statements that are made at the government-wide level and for each category of fund. Two reasons. Some questions just ask you that directly. Which of the following would be a financial statement prepared by the governmental funds? Other times they'll say what should be reported on the statement of revenues, expenditures, and change in fund balance, and they're not going to tell you that they're dealing with a governmental fund, but you're to know that that is the name that is used to report the governmental fund like income statement, and therefore you would have to use modified accrual accounting for that. Okay, so you need to know the names of the statements because they like to do that. Okay, good. Then we get down to required supplemental information other than the MD&A, and they list some things here, but I'm going to go ahead and take you to this example of a budgetary comparison schedule. Okay, so what happens? With a budgetary comparison schedule, they're going to show estimated revenue, say $2 million. And then they're going to show actual revenue. And that actual revenue is, say, 1,800,000. That, guys, is a budgetary comparison schedule, comparing the budgeted estimated revenue to the actual, right? Okay. Now you come down and they say other supplemental information optional. If it's optional, is it required? No. And they say variance between the final amended budget and the actual. Okay, and you're saying, but John, you just showed me a variance. No, I didn't. Variance would be a column over here that would be labeled variance. Just going to call it var because I'm out of room. It would be labeled variance, and the variance here is what, 200,000? That column that shows that variance is optional. Flashcard that. Isn't that annoying? Okay, flashcard that. So you need to show the budgetary comparison schedule. The showing of the variance is optional. Now, guys, I'm going to be doing this to you tonight. And I want you to get used to flipping around a little bit because my buddy Tom Cox has done an excellent job of basically preparing. I don't see how Tom stays married because he must have been his entire life sitting here putting together a complete set of government-wide financial statements. So he's made up this town called Progressive Township, and he has a whole set of financial information. Most educational materials just hurl a government's financial statements at you and say, there, learn from that. Tom has actually prepared one that is good for teaching purposes. So I want to leverage off of that by showing you the relationship here. But notice we have what? We have a budgetary comparison schedule, and you can see over here, and by the way, we're on page 56. And on page 56, okay, you can see over here that we have the variance. See that variance? That variance is what? Optional. Okay, so Tom has taken the time to put together a comprehensive look of financial reports, and we're going to use that to see the relationship between the things we're talking about in the text and the nice job that he's done preparing a full set of educational, education level financial statements. Okay. Okay. Question.
So, what do you mean by variance is optional? So whatever he prepared that column in the actual government of financial statement, it doesn't show?
What does the word optional mean?
Yes and no. It's just a choice.
You can provide it if you want to. You don't have to. You can provide that variance column if you want to. You don't have to.
Okay.
You know what the word optional means?
So does that mean in all the government financial statement, or they don't need to put the variance there?
They don't need to, but almost everybody does.
Okay, all right, thank you.
Mhm. Okay, good. Now you come over and we talk about the comprehensive annual financial report. Okay, by the way, this is no longer, if you see somebody calling this a CAFR, they should not call it that anymore. It's called an annual comprehensive financial report. Okay, and it's like the annual report of a corporation. Okay, now it is not required. This thing is optional. Okay, but almost every government prepares it because there's an organization called the Government Finance Officers Association. Okay, and the Government Finance Officers Association puts together this thing, and this thing talks about how government should prepare their annual report, and it talks about a lot of the things that we've been studying so far. Okay, and in here they say if you choose to prepare an annual report, you don't have to, but if you choose to prepare an annual report, this is how it should look. These are the elements of that annual report that you prepare. Now, again, you say, so that means that most governments don't prepare it. No, most governments do, because the Government Finance Officers Association, so it's not a GAAP requirement. It's not coming from GASB. That big book I just showed you is coming from the Government Finance Officers Association. And they're the ones that say, this is what should be in this comprehensive annual financial report if you provide it. And if you do, they give you a financial reporting excellence award. And I had students before tell me, well, who cares? Then just don't get the award. Yeah, right. You get hired as the CFO of the city and county of San Francisco. It's gotten the, Excellence in Financial Reporting Award for the last 30 years. Now you're going to turn around and say, well, we're not going to do that anymore. Try that sometime, see how that works for you. Okay, so most governments would provide this, and if they do, it must have these sections: an introductory section, basic financial statements, and required supplemental information. And you don't have to look at this again to know what's in there. It's got to be what? It's got to be the MD&A. It's got to be the basic financial statements, the government-wide statements, the fund financial statements, and the notes there too. And it's got to be the required supplemental information other than MD&A. So what happens? What GASB has told state and local governments you must provide, the GFOA says, okay, pick that required stuff up and do what? Sink it into the middle of this optional document, the annual report. Okay, so that's what we see. Those things that were that basic GASB reporting model. Okay, and by the way, if they have provided the optional information, they would pretty much stick that in there too. Okay, but that goes into the middle. And then there is a statistical section which gives you years and years of data. Okay, if you find yourself reading the statistical section of a state and local government's financial annual financial report, I want you to check your priorities and make sure you understand why you're reading that. Okay, because that's just got tons and tons of information in it. Okay, now what I want you to do is flashcard the sections to this annual comprehensive financial report. Just the headings. Okay. Okay, good. Now you come over and they show us and they remind us, and this is a pretty nice little reminder of how things look. We have our governmental funds, right? We have our proprietary funds, and then we have our fiduciary funds. Okay. And what happens? We remember that the governmental funds use modified accrual, current financial resources measurement focus. Some examples: no fixed assets or long-term debt. For our proprietary, full accrual accounting, economic resources. So we will have long-term debt, we will have fixed assets. And then we have what our government-wide statements, which this is showing it sort of in reverse order of how you would see it. You'd probably see the government-wide statements first, okay? But what do? For our governmental activities, okay, we take all of our governmental funds plus the internal service fund, and we put that in our governmental activities, okay, which we're using full accrual accounting, economic resources. And then for our enterprise funds, we stick those and we put those in our business type activities. And what happens? Our fiduciary funds are not reported at the government-wide level. Why? When you're dealing with operational accountability, that's basically showing how effective and efficient you are at using whose resources? The government's resources. The fiduciary funds do not belong to the government. They are managing those funds on somebody else's behalf, right? The pension assets don't belong to the government. They belong to the government employees, don't they? The investment trust fund. Remember, we said we're keeping track of investments for other entities, not for the government's own investments. Okay. And so for that reason, under an operational accountability focus, we do not report the fiduciary funds. Okay. Okay, good. So with all that, let's go ahead and take a look at our first question tonight. Pull up. Okay, guys, I'm going to go ahead and call time on this one because I think almost everyone's had a chance. And when you take a look, everyone that tried it, almost everybody got it right. The statement of activities of a government-wide statement is designed to primarily to provide information. And since it's government-wide, and notice, guys, if they hadn't said government-wide, we should still be able to answer this because it's a statement of activities. And the answer is A, is operational accountability. There is no financial accountability focus. So I'm not sure why we're choosing B. Maybe someone clicked on that one by accident. And then fiscal accountability is the focus of the fund financial statements, right? Okay, good. Let's go ahead and let's take a look at this one. Okay, good. Looks like most of us have had a chance to take a look at this one. So I'm going to go ahead and end the poll. And most of us got this right. The answer here is C. Okay, but let's just take a look at this one. And they say, which of the following statements about the statistical section of the annual comprehensive financial report of a government unit is true? Statistical tables may not cover more than 2 fiscal years. Well, we saw it could be 10 years of data, right? A statistical table may not include non-accounting information. Now, maybe I should have highlighted a little bit more when we were talking about statistical information, because I was all about the 10 years there, but notice appraisal values, other data, they'll tell you how many shirts they sold in the haberdashery district or something stupid. I mean, there's all kinds of things, of information in there that has nothing that goes beyond just pure accounting data. Okay. Now you come over and so B is not correct. The statistical table is not part of the basic financial statements. That is correct, as most of us got, because the basic financial statement are what? The government-wide statements, the fund financial statements, and the notes there too, right? And obviously the statistical section is not an integral part of the basic financial statements. It's in its own section down there, isn't it? It's not the basic financial statements. It's the what? It's the statistical section. Okay. Okay, good. Financial reporting entity. And the best way to show you the financial reporting entity, in my mind, is through this picture here. Okay, so we've got this person, and this person is going to represent the primary government, and they're going to be holding hands here with this smaller person. Okay, and the smaller person is going to be the component unit. Now, when you look at this, do you get a parent and child feeling? Okay, so the primary government is the parent, and the component unit is the child. Okay, and they tell us that generally the financial reporting entity consists of the primary government. Okay, that's the parent, and organizations to which the primary government is financially accountable. That's what? Component units. Now, are parents financially accountable to their children? Try and have one and tell the government you're not financially accountable to them and see what they say to you. Okay, so parents are financially accountable to their children, right? Now, you come over and I want you to put C page. And remember, guys, I'm going to have you jumping around a little bit tonight, looking at these different illustrations that Tom has put together for us. So when you look over on page 12, okay, on page 12, looks like it's on page 12. Maybe it's page 13. Let me see. Now here it is. On page 12, okay, we have what? We have our primary government. That's the parent in this relationship, right? We have our, as I promised you, our governmental activities and our business type activities. Our governmental activities are going to have what? Our general fund, special revenue fund, debt service fund, capital project fund, and our permanent fund. And we pick up what? We pick up our internal, the S and C PAPI, our internal service fund. In our governmental activities, we have what? We have our enterprise funds, and there is no fiduciary fund reported at the government-wide level. And then we have component units. This, guys, is called discrete. That's discrete presentation. So when a primary government has component units, which are entities to which they're financially accountable, they need to put those in a column on the face of the primary government's financial statements, government-wide statements, the statement of net position that we're looking at here, which is like the balance sheet, and also we'll see the same approach for the statement of activities, which is like the income statement. Okay, so that's the way that is generally going to be presented using what? Using full accrual accounting. And you know that because there's my capital assets, right? Okay. Okay, good. Now let's go back and let's take a look, because all government entities are one or the other, guys. They are either a component unit or they are a primary government. There goes Michael's. That's the first time we've seen your cat all trimester. How many cats do you have? Looks like a parade of them going by. Okay, so what happens? You sit there. I had a cat just like that when I was a kid, a Siamese cat. Looks something like that.
Yeah, right now I've got two. I've got a Siamese, and then I have a kitten I just found at my complex. And she's gray and black. Not quite sure what she is.
I had a cat just like that. I got the cat when I was 12. Cat died, I think, when I was like 22 or something like that. So it lasted about 10 years. But to this day, it's weird. I'll wake up in the middle of the night going, where's the cat? Because the cat always slept with me. And to this day, I'll wake up, where's the cat? And I'm like, and that's been, tell me, trust me, it's been a long time since I was 22. So it was weird. Anyway, okay, so what happens? You sit here and you're either a component unit or a primary government. We saw how that's displayed on the financial report. So how do we know if we're a primary government? How do we know if we're a component unit? Well, the criteria for primary government tells us, and we're going to flashcard the criteria, that any state government is automatically considered a primary government. State of California is a primary government. State of Rhode Island is a primary government. Any state is automatically a primary government. General purpose local governments, such as cities or counties, are automatically primary governments. So the city of San Francisco is a primary government. The county of San Francisco is a primary government. City of Hayward is a primary government. Alameda County is a primary government. Any city, any county, general purpose government, automatically a primary government. Special purpose governments are called special purpose governments because they have a special purpose, such as a school district. What is the purpose of a school district?
To provide education.
Educate the children, and all those songs they sing, I believe the children are the future, and all that is the special purpose of the of a special purpose government. And a special purpose government is a primary government if it meets the self criteria, meaning that it has a separately elected governing board, it is legally separate from any other government, and it is fiscally independent. Okay, and it has to meet all of those criteria to be considered a primary government. If it does not meet all of these criteria, then what is it?
Did that make it a component unit?
Component.
It is a component unit, and it'll be shown on the financial statements of a primary government, right? To a primary government that is financially responsible for that component unit. Okay, so let me give you an example. City of Hayward School District, Hayward School District, has a separately elected governing board, is legally separate from the city of Hayward, and each year it must submit its budget to the city of Hayward for approval. Do we have a component unit or a primary government?
Component.
Primary.
Component unit, because if it has to submit its budget to the city of Hayward for approval, then it is not what? It is not fiscally independent. Therefore, it would be a component unit and probably show on the financial statements of the city of Hayward in that example, okay? So flashcard those criteria and just give yourself a note. Governments that do not meet all of the SELF criteria. I know it sounds like 4, but it's actually 3. Separately elected is 1, legally separate, fiscally independent. Do not meet all of the SELF criteria are what? Component units. You're one or the other. You're one or the other. You're going to be one or the other. You're either a primary government or a component unit. Okay. Okay, good. Now, let's take a look at component units. Okay. And when we talk about component units, I want you to make a flashcard. What 2 methods may be used to display component units on financial statements of primary government? Okay, what 2 methods may be used to display component units on the financial statements of a primary government? And the answer to that question is blended presentation or discrete presentation. Let's look at discrete presentation first. Discrete presentation displays component units in separate columns, and most component units use discrete presentation. And I already showed that to you on what, page 12? And I had you write discrete presentation there. So that's generally going to be the case. Now, there are times when you would use blended. And what we're going to do is we're going to flashcard the criteria for blended so that if you see the criteria for blended, then you know that you have to use blended. Otherwise, you're going to use what? Component, right? Okay, so blended is sort of the exception. So the board of the component unit is substantially the same of the primary government, or the component unit serves the primary government exclusively or almost exclusively, or the component unit is not a separate legal entity. Okay, now go back to the little example that I gave you. City of Hayward's Unified School District, we already decided was a component unit, right? Should it use discrete or blended? The board was not the same, right? I said it was a separate elected board. And I said that what? It was a separate legal entity. Okay. But does the component unit serve the primary government exclusively? Who does it serve? Who does a school district serve?
It would serve the citizens of Hayward, right?
The school kids of Hayward, right? Okay, so under that example, since it didn't meet any one of the criteria, that school district would use discrete presentation, right? It didn't meet any of those criteria, so it would use discrete. If it met any one of those criteria, then we would use what? Then we would use blended. Now, I can't turn you to a page where I show you blended, because what? That'd be like taking a milkshake and showing you, well, here's the ice cream, here's the milk. They're blended, right? They're together. Okay. Okay, good. So with that, let's go ahead and we don't need all that flow chart, is overkill. Okay, so let's go ahead and let's take a look at this one. Okay, good. Looks like everybody got this, and it's going to be a discrete presentation. I think you kind of saw the similarity to what we were talking about with the Hayward School District, right? Now, sometimes students will say, well, it didn't say anything about whether it was legally separate or not. Well, look, if the question doesn't say it, you can't assume it. So you couldn't just say, well, gee, they're not legally separate. You don't know that because the question didn't call out the legal status, right? So you would just have to go with the facts that were given there. Okay, good. Let's go ahead and let's jump ourselves into the next module here as we start to take a closer look at the government-wide statements. Now, we jump in straight to the government-wide statements. We're going to see a brief discussion of the MD&A. And for some reason, they pushed that back to the end. I thought it was fine when they had it at the beginning because we were going in order of the GASB 34 reporting model. I don't know why Tom saw it necessary to push it back to the end, but we're going to just go ahead and start with the statements, starting with the government-wide statement of net position, and then we'll talk about the statement of activities, okay? Now, the net position format, okay? Governments are encouraged to report net position as the difference between assets plus deferred outflows of resources and liabilities plus deferred inflows. Remember, we said deferred inflows are like liabilities, but not quite. They're next to the liabilities. Deferred outflows are like prepaids, but not quite. They're next to the assets. Now, it's all assets, current and non-current, and they have to show the difference, okay? Now, for our governmental funds, okay, the required format at the fund level for our required funds is what? Current assets equal current liabilities plus fund balance, right? Okay, that's how you had to show that. Here, the focus is on the net position. Thus, they call it the statement of net position. Okay, what is the bottom line here? Okay, and then what happens for our proprietary funds? This is the encouraged format. And for the fiduciary funds, this is a required format. Okay, so make sure you're comfortable. If you haven't flashcarded that previously, it's encouraged this format at the government-wide level. It is also what encouraged for the proprietary funds, and this format is what required for the fiduciary funds. Okay, so make sure you've got all that flashcarded. Okay, okay, good. Now you come over and we have three categories of net position, three components of net position: net invested in capital assets, restricted and unrestricted. This is the same as my proprietary funds. Same as proprietary funds, and I gave you the mnemonic for that, what? Run. Okay, so just remember the categories of net position, just as we said for our proprietary funds. That is the same format for our government-wide statements. Okay, there's our government-wide statement that we were looking at earlier. There's our governmental activities, includes the governmental funds and the internal service fund. Our business type activities include our enterprise fund. There's our component unit using discrete presentation. We have what? Assets, both current and non-current. We have liabilities, both current and non-current, right? Full accrual accounting. There's our categories: net invested in capital assets, restricted and unrestricted. So there's the run. Okay, and notice that what? The focus is on the net position. Okay, so we simply take what? We simply take, if you want to calculate net position, You take your assets minus your liabilities, and that gives us the net position, right? Okay. Now, let's see if we can figure out, because remember, this is a consolidated statement, right? Let's see if we can find the relationship to the fund financial statements. Now, take a deep breath, guys, because I am going to be asking you to flip around a little bit here. Okay, so the first thing I want you to do is go ahead and circle this 1,835,000, circle that. And then I want you to put C page 27. See page 27. And then we're going to go over and take a quick look at page 27. And when we do, okay, I should probably say see page 26, to be honest with you. I mean, the number is actually on page 27 that I'm going to be looking for. But let's go to page 26 and notice we are now down at the governmental, at the fund financial statement level, and we're looking at what? We're looking at the proprietary funds, and we have our enterprise fund, and we have our what? Internal service fund. Okay, and it turns out that this government has two enterprise funds, water and sewer and parking. And what they do is they add these two columns together, and it creates what? The total for our enterprise funds, doesn't it? Okay. Now, the reason I said see page 27, because that's where you have to go to get to the total for the net position. And the total net position for these two enterprise funds is 1,835,000. Is that the number that we were looking for? Is that the number we were looking for? Okay, so go ahead and put C page, and I believe it was page 12/13, whatever. Okay, and come back now. Oops. And let's go back to, what did I say, page 12. And when we go back to page 12 and then to 13, there's that 1,835,000. So we didn't lie. We took our enterprise funds, we consolidated them, didn't they? And reported them all in that column right there. Okay. Now you come over and let's try that same trick now with our governmental activities column. Okay. So when you look at the governmental activities column, I want you to put C page 24. Okay. And when you come over to page 24 here, okay, page 24. Where are you? And I should probably say page 23, guys, because I'm trying to focus on the number that I'm looking for. But when you first look at page 23, notice these are governmental funds. So we have what? We have our general fund. Okay, we have some different, other governmental funds, and we have the total governmental funds. So these are all my governmental funds. And I come down and remember the inventory, 55,000, remember that discussion. And you can keep going down and you go to page 24 and you see the fund balance. And you see that we have a total fund balance of 4,195,000. Do you see that? Is that the number we're looking for? No, we were looking for what, 3 million something? What was it? We were looking for 3,730,000. That's not the same number, is it? And it shouldn't be the same number because what? We're sitting here and we're only dealing with what? Current assets current liabilities equaling the fund balance, whereas at the government-wide level, we had what? Both current and non-current items. Okay, so it makes sense that it wouldn't match. Okay, so I want you to put here, see page 35 to 36. Okay, and so let's go ahead and let's jump over to page 35. And when you come over to page 35, they talk about the reconciliation. Okay, and we're going to have a reconciliation of the government fund financial statements to the government-wide financial statements. Now, when you look at these, okay, there are two reconciliations. Okay, so put here two reconciliations. Okay, and the one we're looking for right now, number one, let's put a 1 here. Okay, this is Recon 1. By the way, only we call them Recon 1, Recon 2. That is not something that the exam or the GASB or anybody calls it. I'm calling it Recon 1, Recon 2, but Recon 1, Recon 2 is going to reconcile the balance sheets, isn't it? Okay, so you come over and you look at the reconciliation and notice we do what? We start with fund balance, and that fund balance that we started with here was taken from page 24. We start with fund balance and we reconcile to what? Ah, there's the number we're looking for. That's that 3,730,000. So you saw that on what, on page 13? And you start to look at the reconciliation, and what do? They add capital assets. They subtract long-term debt. So far, this is exactly what I did in that simple little example with $1,000, right? Now, remember that we also have differences between modified accrual and full accrual. And remember the revenue recognition rules. If the revenue is going to be collected more than, and the rule of thumb was 60 days, then it wouldn't be counted as a revenue for the fund level. Meanwhile, at the government-wide level, using full accrual, if it was, say, a derived non-exchange, we would take that revenue when the underlying transaction took place. So if the sale took place in 2002, even though the government wasn't going to collect that until, say, March of 2003, 2023, do they collect the sale took place in 2022? What year are we in? And then they weren't going to collect that until what? Until March of 2023. Well, that would be one that would what? Not be a revenue at the fund level, but it would be a revenue at the government-wide. So they just go ahead and they do what? They add in that deferred inflow, because that would be reported as a deferred inflow. And then they go ahead, it'd be a deferred inflow at the fund level, be a revenue at the government-wide level. And then they go ahead and they have what? They have the net position of the internal service fund, because notice the internal service fund is included with the what? With the proprietary funds at the fund level, but at the government-wide level, it's under governmental activities, isn't it? So for that one, you could go ahead and put down hang on a second, guys. I didn't write that down there. See page.
I think it's 27.
Thank you. Yes, see page 27. Okay. And when I tell you to see page 27, Now you come over to page 27. Thank you, Michael. And when you come over to page 27, you look, and again, that was our proprietary funds, which started on page 26. But when you look at the internal service fund column, right? We're in the internal service fund column, and you come down and you look at the net position, you see that 163,000. That 163,000 had to be picked up and added to the governmental funds to trace up to the total governmental activities column. And we saw that the reconciliation was on page 35. So you can see where that number went on page 35. Okay, now when you deal with the reconciliation, much of what we're going to look at when we start to look at that again a little bit later is going to be very granular, very detailed examples, guys. I'm of the opinion that a question on the exam is going to pick up 1 or 2 reconciling items and expect you to know what to do with them. They're not going to sit there and give you 52 reconciling items, okay? So I don't think you need a mnemonic the way they're doing or anything, all this. You'll see they'll trying to offer you a mnemonic in that. That is overkill. Just understand the process, right? And you get 1, 2 questions on the reconciliation. You should be in good shape to answer those, okay? Okay, good. Now you come over, and I believe we were on page 12, where I was showing you how we got the total net position and how we had to reconcile that from fund balance to net position, right? Okay, add the assets, subtract the liabilities, deal with any differences in the way we account for revenue, and add in the internal service fund. Is basically all we did there. Okay, all right, good. Now you come over and let's take a look now at how we will account for capital assets. And since we're under full accrual accounting, as you well know, we have to do what? We have to capitalize the assets. And when you capitalize assets, you will depreciate those assets. Okay, so we're going to be having capitalization of assets and we're going to have depreciation. Now, infrastructure assets refer to streets, bridges, gutters, and other assets of the government, not buildings. An infrastructure asset is something that is part of a system. Is a bridge part of a system? If it isn't, don't drive across it because you will drive off the edge of something. So bridges connect up to roads, and so on. That's part of a system. You know, if you live in San Francisco, you get some of the better water. You're getting water from the Hetch Hetchy Reservoir. Hetch Hetchy is up by Yosemite. Yosemite, it's a long way from San Francisco, so they need a system, a network that gets the water. And by the way, Hayward gets the same water because the pipes have to run through Hayward. What I think is unfair is that we have to go up to a pipe to get our water. No, I'm just kidding. It comes to your house. But what happens? They had to run the pipes through Hayward. So part of the deal is parts of Hayward also get Hetch Hetchy water. Okay, so infrastructure should be recorded as a capital asset. Okay, now the required approach is that assets are depreciated, but there is an exception called the modified approach. Okay, and that applies to infrastructure assets that are part of a subsystem. Okay, so it's got to be part of a subsystem like a bridge, a road system, and they are not required to be depreciated as long as 2 of the criteria are met. And the reason being, it is very hard to talk about depreciation of a bridge. So what are we going to say? Someday it's going to crumble to the ground? No, they're going to sit there and they're going to be constantly keeping that going. And so depreciation of something like a bridge doesn't really make any sense from an accounting standpoint, right? Roads, water systems, they're not going to depreciate those down to nothing. They're going to keep them going virtually forever, right? Okay, so what they say about infrastructure assets is you don't have to depreciate them under the modified approach as long as you have an asset management system that has an up-to-date inventory of the eligible infrastructure assets, gives a summarized condition assessment, good, poor, etc. And each year there's an estimate of the amount needed to maintain and preserve the eligible infrastructure assets. Now, what we're going to see is that part of our required supplemental information other than MD&A is going to require us to call out certain information. And probably when GASB was writing this statement, they got some kickback from the auditors who said, well, if you're requiring governments under the modified approach to provide this information, how are we supposed to audit it? And so GASB probably said, okay, we're going to require a system that is going to generate the information that we're going to ask governments to provide so that you can audit it, okay? Because it's a little unusual for a standard setting body to talk about a system that has to be developed and then talk about what? Documentation that provides data that is going to feed into these reporting requirements under the required supplemental information. So I have a feeling the AICPA, the auditors must have got in there and said, can you help a brother out and create documentation in a system that will generate this information so we have something to freaking audit as part of this required supplemental information that you're requiring? Okay, so they have to meet those two requirements. But I think what I really want you to flashcard here is what is the RSI that has to be provided. So the required supplemental information, guys, we're now talking to you about that bottom box down there, required supplemental information other than MD&A. There has to be a schedule reporting the condition of the government's infrastructure and a comparison schedule of needed and actual expenditures. Okay, so even though we're not reporting depreciation, if a government is letting its infrastructure assets deteriorate and they're not spending enough to maintain a certain level of quality, then in effect they would have depreciating infrastructure and you would see it here, right? Now it is buried down in a note that not a note, but it requires supplemental information that maybe only a nerdy accountant knows where to find it, but it is there, isn't it? And they don't have to report depreciation. Okay. Okay, good. Now you come over and you take a look at historical artwork and historical treasures. Okay, now it's funny. The Hayward Historical Museum has everything about the history of the city of Hayward. There's so much in there about the history of the city of Hayward, it'll take you 15 minutes to go through there. So I like sitting there one time and told a friend, no, come to Hayward, we'll go to the museum. I'm thinking I have a whole day's worth of fun activities. 15 minutes later, we're walking out of there going, well, now what do you want to do? Let's go get drunk somewhere because there's not much in the historical museum, okay? But if you go to the back of the museum, there are 3 pitchforks that were used to start the city of Hayward. A gold pitchfork, a silver pitchfork, and a bronze pitchfork, okay? Does Hayward have to include those pitchforks on their financial statements? And the answer is that Hayward does not have to report those as long as they meet the 3 following conditions. And you may be having a deja vu because we said the same thing for not-for-profit. The collection is held for public exhibition, it is protected, preserved, and the policy is that if Hayward sells one of those pitchforks, it can use the proceeds, or it must use the proceeds to what? Purchase other works of art. And if it meets all 3 of those, just like we said for not-for-profits, then it does not have to record those works of art and treasure on their financial statements, historical treasure. And guys, there are no pitchforks. Okay, so that's because I had somebody say to me, I went to the museum, but I didn't see the pitchforks. I thought everybody realized that was a joke. There's no pitchforks there. Okay, but if they had them, they wouldn't have to report them as long as they met these criteria. Okay, all right, good. Statement of net position, the balance sheet. statement of activities is like the income statement. We're still at the government-wide level, right? LIKEIS is the income statement. Now, what I want to do is first look at the statement of activities and then go back to the outline. Okay, and see if we can pick up what the outline tells us about this. Okay, so notice we come over and we have the what? Statement of activities. We have the primary government. We have what? Component units. There's the column for component units. So that is just like we saw on the statement of net position. We have what? We have government activities. We have business type activities. Government activities, okay, is going to be the general fund, special revenue fund, debt service fund, capital project fund, permanent fund, and the internal service fund, the S&C PAPI. Business type activities is what? Enterprise funds. And of course, we don't report the fund financial statements. Okay. Now, we take a program approach. And remember, we talked about programs or things governments do. For example, public safety was something that we talked about. The government tries to keep you safe. Okay. Now, what happens? We come over and we start talking about program revenues. These are revenues that are generated by these programs. So what happens? We have a charge for service. Charge for service is an exchange revenue. And then we have operating grants and capital grants. These are government mandated and voluntary non-exchange. So that's a couple of our categories of non-exchange, right? We had government mandated and voluntary non-exchange. Okay, now what happens? Notice on this statement of activities for the government, we don't get very far and we start telling you almost immediately what the expenses were for public safety. So this government spent what, $1,025,000 on public safety, fire and police department, whatever. Okay, then what? Then we start telling you, well, what were the charge for the services? And we say 78,000. Now you look at that and it's like, how does the government charge for public safety? Well, we got to pay off the police now to protect us? No, probably. And well, definitely what's included in here are tickets, speeding tickets, which I don't know, I don't feel very served when I get a speeding ticket, but okay, they kind of buried it in there. But let's say you had to pay for a permit for a parade or something, and you had to pay the police for protection during the parade, that might be a charge for service. So these program revenues, and by the way, guys, we're going to give you a mnemonic later, so you can put an S here, an O, and a C, charge for service, operating grant, capital grant. We're going to sock these away, okay? And what these do is they go ahead and they defray some of the cost of the programs. So after we consider the expenses, either direct or indirect, that were allocated to this program, then we go ahead and we subtract off whatever program revenue we have, and we're left with a net, okay, a net expense in most cases. Now, when you look at all of these, look at these loser programs. Look at this. Every single one of these programs lost money, didn't they? Okay. So how did this government cover the expenses for these programs? And thank you, God. Thank you for what? Taxes, property tax, franchise tax. So these are things like what? These are also non-exchange. But these are what? Derived and imposed non-exchange. Derived and imposed. That says imposed non-exchange. So there we go. There's our derived and our imposed non-exchange revenue down there. Okay. And so thank goodness for the taxes, because after the taxes covered all these programs, we had what? We had 794,500 left. We added that to the beginning balance of the net position, and we already saw the ending balance, right? Okay. So this change in net position right here is sort of LIKE, like net income, but we call it change in net position, but it's sort of like net income, isn't it? Now, I had a student one time got all upset in class and says, the government owes the people a refund for that money. Okay, whatever your position is on that, fine. Just know that this government had some amount left over, and that was like net income, but we call it change in net position. Okay, okay, good. So really, this is an upside down income statement. Really, the expenses of the program revenues are pretty much at the top. And then the revenues that come to save us, these what? These non-exchange taxes pretty much are at the bottom, aren't they? Okay. Okay, good. Now you come over, and as I said, we would go back, and let's just see before we go to the break here, if we can tie this back to the statement of activities on page 18. You can go ahead and say, see page 18. Okay. All right. So we did see a program approach, right? And the program that we saw, function and program that we saw, the program that we focused on was what? Was public safety. And we saw that we saw that there were governmental activities and business type activities, and we saw the component units, right? We didn't get very far, and there were what? Expenses. And I think the expenses was 1,025,000 was what we saw. Okay. And then we got to program revenue, and we had what? We had exchange, and we had non-exchange, right? Okay. And when we looked at our exchange revenue, exchange was charge for service, okay, including fines and whatnot. Okay, so that was the S and SOC. That was an exchange revenue. And then we also had what? We also had operating grants and capital grants. That was the O and the C. Okay, but those were what? Those were both non-exchange, mandatory and voluntary non-exchange, and I showed you that. Okay, and then we had the net expenses. And in our little example, I think our net expenses came to 982,000. Right, we had all those loser programs. And then we had general revenues, and the general revenues were mostly taxes. And it was at the bottom, near the bottom anyway. And then we had change in net position. Change in net position was LIKE, like net income. And in our little example, the guy wanted a refund for that 794,500. Okay. Okay, good. And so the main thing I want you to flashcard here, there's the statement itself, is the category of non-exchange revenue, which we saw a couple times. A category, excuse me, of program revenue. Not exchange, because service is an exchange. Okay. All right. You want to take the break, or you want to do these questions and then take the break? Dumb question, right? Break first, huh?
Break first.
Okay. All right, good. Let's go ahead. Let's take 10 minutes. We'll come back. Let's just make it an even 6:45, guys. Okay, so we don't have to deal with weird times. So we'll just make it an even 6:45. We'll come back. Okay, good. So let's go ahead then and let's take a look at, maybe did you guys work this during the time that we were over break or no?
I worked the first two.
Okay, I think that's all we have. Oh, no, we have the 3 also, but I don't want you to work that one anyway. So, do you guys need time to work this right now? Question 1 and 2? No? Okay, so let's go ahead and let's just look at it together. So on March 1st, this WAG City issued $1 million 10-year 6% general obligation bond at par with no bond issue costs. The bonds pay interest September 1st and March 1st. What amount of interest expense and bond interest payable should WAG report? And we're at government wide, so we have to use what? We have to use full accrual accounting, right? Okay, so if they issue the bonds on March 1st and they're asking us what? December 31st, could it be true that well, it can't be true that there is no what? There is no interest expense, which they didn't really give me any. They had interest expense anyway, 0. So now I want to look and I'm going to think, well, let me figure out the interest expense then. And if I'm using full accrual accounting, it was $1 million. It was what? A 6% bond, and the bonds were outstanding March, April, May, June, July, August, September, October, November, December. They're outstanding for 9 months, right? Okay, so I go ahead and I multiply that times 9/12, and that gives me what? $50,000 of interest expense.
I had outstanding for 10 months,
Oh, is it 10 months? Okay, 10 months.
but it does give you the 50,000.
Gives you the 50,000. Okay, yeah, I didn't count carefully. Always count carefully on your fingers. I have it written down as 10/12 and I counted 9. So it's 10/12 or 50,000. Okay, now when I look, I know that either A or B is correct. And then I look, and if they did what? If they paid the interest on September 1st, right, then it would have been true that interest would have accrued for what? Would have accrued for September, October, November, December, for another 4 months, right? But they're not going to pay interest again until March of the next year. So there's no way that the interest payable would be 0. It has to be some amount. And at that point, I don't even need to make the calculation to know that A is the answer. But just because we're good, solid accountants here, let's go ahead and do it. It's going to be the $1 million times the 0.06 times what? Times September, October, November, December, right, Michael? 4 months now. You get that right?
Yeah.
4/12 gives me what? 20,000, which I knew it was going to be the 20,000 because there's no way it's 0. Time saver on the exam. I don't know. I might go ahead and calculate it anyway, just because I don't trust myself. But if you were really, really, really pressed for time, you really could just go ahead and go with A there. Okay. Okay, good. Now B would never be correct. So let me just stop there. Not in this situation. Now we go over and we look at question 2. During the current year, Knox County levied operating taxes of $2 million, for which 1% is expected to be uncollectible. The following amounts were collected, and they give us all this information about collection, and then they tell us that they're at government wide. Now, the trick of this question was that they wanted you to get all tangled up in figuring out collection information, and they don't give you enough information here to really know what to do under modified accrual. I mean, this, you'd never be able to get to the answer for modified accrual, but they're asking me government wide, which is full accrual. So when I collect the money is of no consequence here, right? And since they're dealing with property taxes, I don't need to worry about if I'm eligible here. So what would happen? I would take the $2 million, But since I report my revenue net of any uncollectible amounts, right, I would multiply that times 0.99. That would give me the correct answer here, which is this 1,980,000. Now, just to contemplate the entire journal entry, I would debit taxes receivable 2 million. I would credit revenue for 1,980,000, and then I would credit the allowance. What's that? 20,000 is the difference. Okay. I could not answer this question for the governmental funds unless they told me something about what their criteria was for collections. For recognizing revenue. Okay. Okay, good. This one will come back. So I'm glad you didn't work this yet. We'll come back. This is Recon 2 that we haven't had a chance to talk about yet. We will come back and talk about it. I don't know why Tom put this question here. It doesn't belong here. Okay, good. Now we come over and we start talking about fund financial statements. And unfortunately, I am not satisfied with Tom's explanation here of major funds. It is almost impossible to understand. So I have this set of slides up here, which were for under chapter 8, or maybe under chapter 9 when we were looking at the fiduciary funds. Remember, I ran you through a set of flashcards, and then at the end, I had not flashcards, but PowerPoint slides, and then I had this information here. Okay, for major funds. Okay, what is going on here? So major funds, okay, and what happens is that a government can have hundreds of funds. And if it reported every single fund on the face of the financial statements, we would destroy the conceptual framework idea of understandability. So what we do is we only report major funds on the face of the financial statements. So the general fund is always a major fund. General fund is always a major fund, okay? Then we start talking about enterprise funds and governmental funds that would need to be reported on the face of the fund financial statements if they are considered a major fund. Now, when you look at the criteria, there are two. We'll need to look at all the different line items except fund balance, except net position, and see if the fund constitutes 10% of the related governmental funds or 10% of the related enterprise funds. And then we need to see if they meet the second criteria, which is, do they meet 5% of the combined total of all the governmental funds and all the enterprise funds. Now, when you look at this, and guys, this is a little hard to see on the screen, but I decided to lift this from another source, and they give us these different funds. And in this example, guys, they're only giving us governmental funds to consider, but we would do the same thing if we had, say, an enterprise fund here, okay? But these are all governmental funds, and we go through and we look at each fund individually to see if it is a major fund. So we start with the road fund, road tax fund. You can see that. You can see the assets are 1,369,000. Now it's not shown here. They just give us the number of the 10% of the total governmental fund and 5% of the total of the governmental funds and the enterprise fund. Okay, so they're just giving us that number here, right? Okay, they took the total governmental funds, multiplied that by 10%. They took the total of the governmental and the enterprise funds together, mushed them together, and multiplied that by 5%. Now, when we look at the assets of the road fund does not pass the 10% test. Therefore, it is not a major fund for assets, right? It is not a major fund for assets because the assets are 1,369,328. It flunked the 10% test. It's not a major fund for assets, but it may be a major fund based on liabilities. So I go to the next line item, liabilities, 172,439. It meets the 10% test, but it fails the 5% test for liabilities. So again, it is not a major fund. Then I go to revenues. I look at revenues, the road tax fund, 4,289,876. I look at the 10% column. It doesn't pass the 10% test. It's not a major fund. I go to expenditures, 3,986,746. I look at the 10% of the total. It fails the 10% test. It is not a major fund. We don't use fund balance for this. So now I look at the debt service fund. And I look at the debt service fund. Debt service fund, it passes the 10% test. No, it doesn't. For assets, it does not pass the 10% test. Not a major fund. Liabilities, doesn't pass the 10% for liabilities. Not a major fund. But when I look at revenues, it passes the 10% test for revenue, 6,836,472. It's bigger than the 6,073,695. And it's bigger than what? The 5% test for the combined enterprise and governmental funds. Now I know, and I don't have to go any further, based on revenue, debt service fund is a major fund. And then I come over to capital project fund, and capital project funds kicking ass, right? So it's a major fund on assets, on everything. It is a major fund, okay? That's the way you apply the criteria, and you would do the same thing if they gave us enterprise funds, okay? So those are going to be reported as major funds on the face of the financial statements. And this, trust me, is an infinitely better example, or Tom doesn't even give you an example. Tom just, in my opinion, talks into the ground here as to what you're supposed to be doing. But you can see the 10% test, the 5% test, right? Okay, so with that, let's see if we can answer this question. I'm trying to find the poll. There it is. Okay, guys, we're about 2 minutes into this. So I'm going to go ahead and end the poll, and let's just go ahead and see what we've got here. And most of us got this, that we're able to, well, everyone who got a chance to try it got it correct. So we know that we have what we have to use the 10% and the 5% criteria. Now, when we look at this, we've got what? We've got the total of the governmental funds. Get me back into full screen mode. Okay, we've got the total of the governmental funds. We've got the total of the enterprise funds, right? Okay, now you look and we need to sit here and multiply this by 10% for the governmental funds. And notice, guys, we're doing this all based on assets. Okay, again, we would continue with liabilities, revenues, expenses if we were actually doing this for a government, but we're just focusing on assets for the CPA exam question. So we multiply each category by the 10%. That gives us our 10% threshold. Then we need to do what? Then we need to combine the governmental funds and the enterprise funds. That's 5 million when you add those up. And we multiply that times what? 0.05. That gives me 250,000. Now I go through the listing to see which of the funds met both of those criteria. Now, general fund, you may look and say, well, wait a minute, general fund didn't meet the 10% test, but it doesn't matter because what? General fund is always a major fund, right? Okay, so I didn't even need to look at that one really. Then community development, it is passing what? It is passing both the, no, it is not. It is not passing what? Community development special revenue fund, that's a governmental fund. And it did not pass the 300,000 test, so it's not a governmental fund. I mean, it's not a major fund. It is a governmental fund. It's not a major fund. Then the what? Special revenue fund 350, 250, that passed both of them. So I have two now, don't I? Okay. Then I go general revenue bond debt service fund. It's not passing the 10% test, so it's not a major fund. The capital project fund, just like in our example, it's making a big time, right, based on assets. So that's 3. And then the water utility, as most of the time water utilities are huge, so it probably would always be a major fund. That one passes. And then the landfill, which would be a debt service, which would be an enterprise fund, passes the 10% test, but not the 5% test. So it's not a major fund. So the answer here is 4, which most of us got. Question.
Yeah, I was wondering, is there a limit to the number of major funds government can report?
There is not a limit. The criteria is that if they meet those tests, they are to be reported as a major fund. Okay, so major funds must meet the 10% and 5% criteria, and those are to be reported as major funds.
Okay, thank you. I guess that would effectively make it limited to at least at most 10, huh?
Yeah, it's not giving us, is it giving us the rule? Because I think what you're talking about, what you're calling up is for the segment reporting. They
Yeah, I
tend to
think
tell us
that's
it's not more than 10, but I don't think that it says purely based how many funds should be displayed as major funds, which is kind of telling me I have to do it, right? It says should.
okay.
Yeah.
Thank you.
Mhm. Okay, good. Now, guys, they're going to start to repeat all the fund financial statements for the sake of time. I'm not going to walk you back through all the fund financial statements, governmental fund, proprietary fund, fiduciary fund. We've looked at those in previous class, but what we really have not spent time with at this point that I do want to spend some time with you is statement of cash flows requirements for our proprietary funds. So let's go ahead and let's take a look at the statement of cash flows. Now, I have had a dream. Students have come up to me and told me, oh, I had a statement of cash flows for an enterprise fund as a task-based simulation. And I said in the dream, oh, how'd you do on that? And the person said, not very good. And my answer is to that, well, why? Because we've talked about statement of cash flows. We've talked about statement of cash flows. We've talked about it what? We're talking about for-profit, not-for-profit. Now we're talking about government. So we've had quite a bit of exposure to the statement of cash flows. And if you get that task-based simulation, what you should do is pretend like you were preparing a statement of cash flows for a commercial entity, which I know you're going to be very good at that. But when you come to one of these areas where they tell us to do something different for government, do the government thing. Points, 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 just for knowing what some of the differences are, right? Okay, and you should be able to survive quite well that task-based simulation. Okay, so they tell us that it is similar to commercial with 6 important differences, which you should flashcard. And right out of the gate, you're going to get points for knowing that you should use the direct method. You have to use the direct method. You know, FASB lets corporations get away with using the indirect method because there may be certain information about cash collected from customers that they don't want their competitors to know about. Public entities don't have that excuse. So you must use the direct method. Okay. Now, just as when you use the direct method in commercial, you have to provide a reconciliation, and in commercial, it's a reconciliation net income to cash provided by operations. The government version is much more sane. It is what? It is operating income to cash provided by operations, which in my opinion, the commercial version should start doing this. Okay. Now, we're going to see some nice results that come from that here in a second. But instead of 3 categories, there are 4 categories. So we still have operating and investing, but we take our financing and we break them into whether they are capital related financing or non-capital related financing. So if we borrow money for equipment and we incur interest, that would be what? Capital related financing. If we have borrowed money for what? For an operating loan, that would be considered what? Non-operating financing activities. Okay. Now they tell us here that the category, the financing and investing are reversed. Okay, so we will have financing before investing. Go ahead and flashcard that. I'm not sure the examiners are going to be awarding a whole bunch of points for that. Okay. Now, interest income can be reported as investing, will be reported as investing activities, not operating. Do you see how much better that is? In commercial, what? In commercial, the interest is up there in operating. Meanwhile, it gets confusing because on the income statement, it's considered non-operating, right? But if you reconcile operating income to cash provided by operations, now interest income can be pretty much where it belongs, which is what? As an investing activity, okay? And then our interest expense will be either capital or non-capital related financing, not operating like we're stuck with doing in the commercial version. So I'm a fan of the government version, and that's not because I worked for the government all those years. It's because what? It's more rational as to where you start placing things, right, into the different categories. And then capital assets purchased are reported as financing, not investing as they are in commercial. And generally, the reason is that if we purchase a capital asset, we probably have received that financing from some other source. And so we just go ahead and contain that all down in financing. Okay. Okay, good. 7 differences that you should know, flashcard. And then the other thing, guys, and I think it's very unfair, but you're going to have to flashcard the nature of government activities and where they go on the statement of cash flows, which I think is highly unfair because they're really asking you to know more about government operations. And I think you should be required to know, okay, for the exam. But what are we going to do? They're writing the exam. So cash inflows from the sale of goods and services, that's probably no brainer for operating. Cash supplied to employees. Cash inflow from interfund reimbursements, including payments in lieu of taxes. Cash transactions not meeting the definition of the other categories. Investing activities, cash flows and outflows associated with loans to others. cash flows and outflows associated with equity transactions, which there are really not a lot of those in government. Okay, capital related financing, cash flows from issuing debt associated with capital assets, cash inflow from capital grants, cash inflow from contribution activity associated with capital assets, cash activity related to special assessment associated with capital assets. Sorry, guys, I know I am reading, and the reason I'm reading is because, this is quite granular, and I think it is really unfair for them to expect you to know this, but by the same token, there was that task-based simulation. And in the task-based simulation, in the dream anyway, what they did is they gave you the change in cash from these, the amount of cash that was generated from these things, so you didn't have to calculate that. You just needed to categorize it into the right sections, and you had to know to use the direct and the indirect method, etc. Okay, and so cash flows from issuing debt for non-capital, cash receipts from grants or subsidies, cash receipt from property taxes, and operating transfers. Okay, now we give you a question here, guys, and you can see that they use the direct method. Okay, and then they had the cash provided by operating activities. And then when they reconcile from operating income. Oh boy. Okay, well, I dared to touch the cord. And now because I dared to touch the cord, everything is screwy. Can you hear me?
Yeah, we can hear you. Or I can.
So I'm just going to go, because if I try to revive the camera, it's going to be a whole thing. I graze against the cord to the camera and the machine loses its mind. Okay, but what we did was we had operating income, not net income. Okay, and we reconciled to cash provided by operating activities there. Okay, so there's that reconciliation. And then you come down and you can see where they put the rest of the different categories. Okay, now I'm not going to go through fiduciary fund statements. We've seen those in our last discussion from last time. And I'm just going to tell you that the answer to this stupid question is since we're looking at it, the answer to this question is B. I am not going to go through this question because it's basically predicated on your memorization of all those flashcards I just gave you. So that's the best way you'd be able to answer that as to what category these things go in. Okay, I want to jump to the reconciliations. We have looked at the reconciliation of the balance sheet. We did that earlier, right? We went through that whole exercise. Let's see now if we can do the same thing with what I am calling Recon 2. And this is a reconciliation of the operating statement, of the income statement. So you reconcile the balance sheet, you reconcile the income statement, okay? Now, you take a look and you see the net change in fund balance, total governmental funds, and I want you to put here, see page 25, okay? So you come over to page 25. Okay. And, you should probably start on page 24, but the number we're looking for is on page 25. But we have the statement of revenues, expenditures, and changes in fund balance, right? And this is for my general fund, et cetera, all my governmental funds, my total governmental funds. And you come over and you see all these different expenditures. For example, we have what? We have an expenditure for capital outlay of different things that we purchased, right? We have the capital outlay expenditure sitting here, this $787,000. We have what? When we pay the principal on debt, we take that out, right? And then we have, remember when we had issued the debt, that was an other financing source. Remember we had issued 202,080,000 of debt. Okay, so all of these different things lead up to that total change in fund balance, which is the 171,500. That was the number we were looking for. So we were looking at that reconciliation on what page was it, Michael, that we were on? Where we were just looking.
38.
What is it, page 38?
Yeah.
Okay, so go ahead and put C, page 38. Okay, and so we go back to page 38. Okay, and that's that number, right? And we're going to reconcile to this 794,500. Okay, and for that one, you can put C, page 18. And when you go up to page 18 over here, okay, right here, page 18, remember the money that the guy wanted the refund for? Okay, the student gave me a hard time. He said, oh, the people refund for that like net income number, is that number? The 794,000. So for there, you can put, what was it again, page 38? See page 38, you come down to page 38. Okay, and so we're trying to reconcile from the fund number to the government-wide number, right? Okay, so what do? Well, they start adding things back that should not have been taken out as an expense. For example, the payment of the capital outlay, the principal payment on debt. Okay, now the proceeds of land sold, they go ahead and they subtract that, because if you weren't carrying land as a fixed asset, you weren't carrying it as a fixed asset, right? And therefore it would have been treated as expenditure when you bought it. But if you sell it for 500,000, then you would show that all as income if you were using modified accrual. But under full accrual, what? You would have to consider it what the original cost of that land was, and you would have to do what? You would have to subtract out that 75,000 to bring it to the net gain. Okay, so we're making an adjustment to bring it to the net gain, because under full accrual, that would be the income. The revenue in the statement of activities that do not provide current financial resources, this would be what? Revenue at the government-wide level, a deferred inflow at the fund level. So we have to add it in. Okay, then because we weren't depreciating the assets, we would have to take out all the depreciation expense. They total that up. And then we have to do what? Then we have to bring in the net income, if you will. Okay, the change in net position for my internal service fund, which they're telling me here is 26,000. And you can go to page 28. And you can see on page 28 here that we will be looking at the statement of revenues, expenditures, and change in fund balance for my internal service fund here. And when you come down, sure enough, the change in net position, the like net income number, the change in net position is this 26,000 right here. And for that, you can put C, page 38. And we need to do that on reconciliation too, because again, we're reconciling the income statement, right? And when you do that, you then total up, reconcile up to that total that was shown at the government-wide level. Okay, that's reconciliation two. So you reconcile the balance sheet, you reconcile the income statement. So you have seen by this markup that we did, how it connects to the entire example that Tom's given us. Okay, but now let's go ahead and let's practice with a couple of examples here to get a little more practice with the reconciliation. Okay, so they tell us that we had what? That we had the fund balance, and they tell us that it's 655. 6,550,000. Okay. And then they start giving me potential reconciling items. Okay. So let's just look at the solution here. And you start with that fund balance. You add in the capital assets. You subtract out the accumulated depreciation. You subtract out the long-term debt. That's just like that first little example I gave you, right? Except I didn't deal with the accumulated depreciation in that one. And then we take in the what? Internal service funds net position to get the answer. Now, when you look back, notice, guys, that they did something to me here. They gave me the fiduciary fund information, and they gave me what? They gave me proprietary fund. Proprietary funds too broad because that includes the enterprise funds, doesn't it? And the enterprise fund is not in the governmental activities column, so it's not a reconciling item, right? So you'd have to know to ignore that. Okay. Now, that's Recon 1, what we call Recon 1, Recon 2, which is reconciling the balance sheet. Let's look at reconciliation of the income statement, okay, which I'm calling Recon 2, all right, reconciling the income statement. And they start me out with the change in fund balance, and then I have to figure out what to do with all these items. And so I start with that change in fund balance, and I start adding back the capital outlay. I add back principal payments. Only principal payments on debt get added back. The what? The payment of interest is going to be considered what? Is going to be considered an expenditure under both, right? So it's just the principal part, okay? Then what? Then I have other financing sources, debt proceeds. I subtract those because they're increasing my fund balance, aren't they? When I have other financing sources. So I need to subtract that. I need to pick up the depreciation expense. I subtract that. And then the internal service fund net position, I need to know to pick that up. Notice, guys, I do what? I stay away from the net revenue from the enterprise funds. I don't need that. I only need the net revenue from the what? Internal service fund, right? Okay. Okay, so with that, let's go ahead and take a look at what I believe to be a pretty comprehensive question on the reconciliation. And if you can do this, you will be in good shape for any question, in my opinion, dealing with reconciliation on the exam. Okay, guys, we're a little over 3 minutes here, and remember, our rule of thumb is you generally don't spend more than 3 minutes on any one multiple choice question. So let's just go ahead and let's take a look at this one. We did pretty good on this one. The answer is B, but this is a pretty tough question. Okay, so let's go ahead and let's take a look at this. If you get something like this on your exam, I want you to look at the clock and I want you to not give any more than 2 minutes to a question like this. Okay, if you got something this elaborate. Okay, maybe if you feel you're heading in the right direction, 3 minutes, but do not spin wheels on something like this. If this was an actual released question from the exam, and I can't remember now if it was, in my opinion, somebody should get a life. They overdid it. Okay, but let's just go ahead and take a look. They want the government-wide change in net position. This is the reconciliation of the operating statement. This is Recon 2, right? Okay. Now they give me the change in fund balance is 500,000. So I know I have to start with that. And then what I reconcile to is going to be the answers. So I start looking at some of these things and they tell me there's a capital outlay of 250,000. So I have to do what? Add that. But then they did what? They found that they funded that by long-term debt proceeds. So I have to sit there and that would be another financing source. It would have increased fund balance. So I have to subtract that, don't I? Okay. Then they tell me current year depreciation. Well, that's an easy one. I get to do what? Subtract that 60,000 because I don't report depreciation at the fund level. I would report at the government-wide level. Principal payments of 40,000 on debt. So what happens if I go ahead and I pay that principal? I'm treating that as an expenditure, but that is not an expenditure under what? Under full accrual accounting. So I have to add back that 40,000. That's an expenditure under modified accrual, is not under full accrual. Interest payments on debt through October 1st of 30,000. I don't have to do anything with that. That is an expenditure both under what? Under full accrual and modified accrual. That is not a reconciling item. So I don't have to do anything with that 30,000. Principal payments of 10,000 incurred through December 31st, but not paid until January 2nd. That is an expense under what? Full accrual, but under modified accrual, I wouldn't have taken that as expenditure because I don't take it as expenditure until I pay it, right? In that next period. So I'm going to have to subtract that 10,000. Then what? Then I come over and I do that right? What did I say? 10,000 principal payments of 10,000. Oh, I'm sorry, my bad. Not the principal. I got my speech mixed up. Principal payments of 10,000 incurred through December 31st, but paid on January 2nd. But principal payments are not an expenditure, right? Principal payments are not an expenditure, and you wouldn't have taken them as expenditure under modified accrual until you paid them in the next year. So I ignore that. Then I come over and now I look at the interest payments, and where I was trying my speech there a minute ago, interest payments of 7,500 incurred through December. The interest, yes, I'm not going to take it as expense under modified accrual until I paid in that next year. But under full accrual, that 7,500 what is an expense because it was incurred through December 31st. So forgive me, I gave the speech for the principal that I should have given for the interest. Okay. And then sales tax revenue of 30,000 associated with December 31st year one sales remitted to the state in February and paid to the township in March. And again, they're just assuming a 60-day criteria here. So that wouldn't be revenue under the governmental funds under modified accrual. It would be revenue under full accrual since the sale took place in year one. It's a derived non-exchange. I add that and I come to the 527,500. Now that question, in my opinion, guys, is overkill. I don't think the examiners will go that far off into the reconciliation, but that's a nice comprehensive. So what do you have? You have the example that Tom gave you as part of the overall financial statement. You have the examples of the reconciliations that were given in those two examples, how to reconcile the balance sheet. You have this question. You'll see a couple other questions, right? So you've got plenty of material to practice with on how to do this reconciliation. Now, having said all that, I'm of the opinion that the more realistic type of question that you would get related to the reconciliation is this one that I promised I would come back to. Okay, so let's go ahead and I'm going to let you do this one. And I think if they ask you about the reconciliation, it is more likely that it would be something like we're seeing here on page 20, which is not nearly as onerous as that other one. Oh, yeah, I'm just now seeing this question. Now I know why he put it here. I thought it was a reconciliation question, but it's not. My bad. It's not a reconciliation question. I thought it was. There used to be one similar to this that was a reconciliation question. This question is simply asking, do you know the difference between internal service funds, enterprise funds, and fiduciary funds, isn't it? Okay, so we're asked to pick up the business type activity. That is what? That is going to be enterprise fund. So they tell me the internal service fund, is that an enterprise fund? No, it's an internal service fund. 12,000 in the water enterprise fund. Yeah, that's business type activity. Okay, so I pick up that 12,000 and then 7,000 increase in employee pension fund. That's a what? Fiduciary fund, which does not affect statement of activities. So at the government wide level. So the only thing that would have affected is this 12,000. So when I looked at that quickly earlier today, I got a little confused. I thought it was a reconciliation question. Now I see that it's not. Okay. Okay, good. Now, one more thing I want to quickly show you before we can spend at least a little time going through the final review material, which is this deriving. Let's see. This deriving government-wide financial statements. Okay, now here's what happened. Let me tell you the backstory on this.
What page, please?
Back to
40.
yeah, page 40. So the backstory here is that Tom Cox develops the government for a period there, was developing the government-wide material, and I was teaching it for the continuing professional education classes. And we had a client that asked us to prepare something that would show how you would derive government-wide statements. And then the blueprint for the CPA exam came out and said, oh, we're going to start asking about how you derive government-wide statements from fund financial statements. And Tom said, oh, hot diggity. I have this example that we had to do from the CPE classes, and he threw the whole thing. Meanwhile, I'm of the opinion that this is way, way, way over the top as to where the examiners would go with this. The examiners might ask you for 1 or 2 journal entries that would be required to derive a set of government-wide statements from fund financial statements, but they're not going to give you something this comprehensive. They're not going to waste a bunch of points on the exam asking you to do a full-blown consolidation from fund financial statements to government-wide. Now, what happens is when you look at this actual worksheet, okay, they start, well, before we get to the worksheet, well, let's look at the worksheet first. I think that's better to look at the worksheet first, then come back to the journal entries. So when you look at this, they show you, come on. I mean, he went hog wild here. Okay. And this is too much. So what happens is they show you, and this is how government would do this, guys. You would basically prepare your financial statements at the fund level. Governments will prepare their financial statements at the fund level, and then they'll convert the fund financial statements to the government-wide. So you're going to have to do a bunch of journal entries to convert fund financial statements to what? Modified accrual financial statements to government-wide financial statements. That's all that's going on here, okay? But I'm of the opinion that they're not going to ask you about every single possible thing that could happen to make this conversion, okay? So what I want to do is I want to go back now to some of the journal entries to show you more in line with what I think they would be doing so that you kind of understand what all those journal entries are. And then you can go through this more comprehensive thing on your own if you want to. Although I would not bother doing this before you, study something else. So if you've got any extra time, you can come back and look at this. But take a look. We have what? Let's just look at this journal entry right here. You spent money on a capital outlay, didn't you? And you treated that as an expenditure. But that is not an expenditure on page 43 here. That is not an expenditure at what? At the fund level. That would be what? An debit to an asset account, wouldn't it? So what do? You would credit the expenditure for capital outlay, debit the asset to turn that into an asset. So by the time it gets reported at the government-wide level, showing as an asset on the worksheet. Okay. What else? If you pay principal payments, okay, that's not an expenditure. So you would credit the expenditure to remove it as expenditure from the fund level, and you would debit long-term debt. So that is reducing the debt account, not the what? Not being treated as an expenditure, and so on. Okay, I'm not going to go through all these guys because it gets too cumbersome for us with the amount of time we have left, and we have bigger fish to fry than this sort of minutia here, this granular derivation from the fund financial statements to the government-wide. Like I said, I'm not sure how Tom stays married, but somehow he has the time to do all this and keep his marriage together at the same time. And his mother lived to be 100 and I think she lived to be 104 years old. So maybe he figures he's got plenty of time left to do this kind of stuff. I don't. And I don't think that you do either. But if you want to sit here and you want to look at, all of this stuff, you can go ahead and you can see all the numbers here and how he turned these statements from, fund level into a set of government-wide statements. And he actually sat there and painstakingly made all those frickin' journal entries and then posted them all to a worksheet to turn fund financial statements into government-wide statements. Okay, and he did the reconciliations and everything else. The man has got to get a life. Okay, we're not going to do this. Okay, but you can look at all those on your own. Question. Okay, I think you're best off just kind of quickly going through that, seeing the kind of entries you would make. Look at the multiple choice question for that. You get 1 or 2 multiple choice questions on that. Just worry about that. They're not going to give you a task-based simulation where you have to do this. They're not wasting 10 points in a task-based simulation on something this granular. Question. Okay, are we going till 9 o'clock? Is that the deal? Or are we giving up?
I'm okay with 9 o'clock.
9 o'clock. Okay, if you're tired, you need to sign off. Not a problem. I'm going to take us as far through final review as I can until 9 o'clock. I'm not going to go past then. Okay, and what I've done is I've selected some things from final review. And what did I do? Close the whole thing now. And what I've tried to do is pick out things that I think might be kind of hard for you, that maybe it's worth revisiting. Okay, so I want to start with the calculation of earnings per share. So guys, that is, and the way they've numbered this book is really, really hard because it's all one file. Okay, but this is on section 1, page D1. So you're gonna have to turn a bit. You're still in section 1, but you're still in whatever they call that, section 1, but you're in topic D. Found it?
Yep.
Okay. All right, good. So let's just go ahead and let's take a look at basic earnings per share. Okay. And with the basic earnings per share, you would have income available to common shareholders, and you would divide that by the weighted average number of common shares outstanding. Now, part of the reason I have selected this is because we didn't talk about this together. Okay, so you should have looked at this, but then we also didn't go through this discussion together. And the income available to common shareholders must be reduced by dividends declared on non-cumulative preferred stock or by the dividends accumulated in the period on any cumulative preferred stock, whether or not those dividends were actually declared. Okay, so we calculated in F7, remember I asked you to make flashcards for all the formula, and so we did have that. Okay, so now what gets tricky on this sometimes is income available to common shareholders, but you have to look and you have to see if it's non-cumulative, it has to be declared. If it's cumulative, doesn't matter if it was declared or not, right? That's the key thing you need to remember there. And then you have to determine the weighted average number of shares outstanding, and we weight each total share outstanding by the amount of time that was outstanding. However, Stock dividends and stock splits are treated as though they occurred at the beginning of the earliest period presented. But that gets a little tricky because if they're showing you 2 years, even though the stock split maybe didn't take place until what? Until year 2, you pretend as though, and you're showing 2 years of earning per share, you pretend that it happened in what? In the earliest year presented in year 1, let's say, if they're showing you year 1 and year 2. Okay, so you start to take a look at that, and then we come over, and guys, you should be working all the questions in your final review. You should be working all of the questions in final review. I don't mean just the ones in the book. You know where to find the final review software, right? In your software, you should part of your exam work every single question in the final review. Go back and look at the how to study file and the final review discussion there. I tell you to work all of the questions in final review. Okay, but let's go ahead and let's take a look at this one, and I will give you, for time's sake, 2 minutes. I know you probably won't be able to quite finish it in 2 minutes, but I want to see if we can get through a lot of material. And we should, at this point, start working on speed, guys. Now, as you head into your exam, we've been focusing on accuracy. Now I'm going to start holding you more accountable to what? To the 2-minute requirement. And by the way, guys, 1 is A, 2 is B, 3 is C, 4 is D. I think you know that. Okay, actually, we're over 2 minutes, so I'm going to go ahead and end the poll. And we're about 2 minutes and 30 seconds there. But okay, of the folks that had a chance to answer this, most of us got it right. It is choice B. Now, this question, more than anything, was simply asking us, can we figure out the denominator in the earnings per share, right? So when we look at this, they tell us that we have 2 years of information. Net income for year 11 is what? 400 well, let's read the whole question. Birkin had 1 class of common stock outstanding and no other securities that are potentially convertible into common stock. During year 10, 100,000 shares of common stock were outstanding. In year 11, 2 distributions of additional common shares occurred. On April 1st, 20,000 shares of treasury stock were sold, and on July 1st, a 2-for-1 stock split was issued. Net income for year 11, okay, is 410, and for year 10, is 310,000. Now, you got to be careful, make sure you know what year you're calculating for here, right? Because the evil examiners did what? Put year 10 in the second column, and that could mess you up, okay? So I'm going to go ahead and I'm going to do year 10 first. And for year 10, they tell me that the income was what? 350. So I know that's the numerator. That part's easy, right? But then I have to look, and they say that during year 10, there was 100,000 shares, but I treat that stock split as though it had happened what? At the beginning of year 10, the earliest period presented. So I have 100,000 shares, but since it was a 2-for-1 stock split, I have to multiply that times 2. So that means that the denominator here should be what? 200,000. So when I go ahead and I do the calculation, I get $1.75. Again, I got to be careful that I know what column I'm in. So I look and I can immediately get rid of choice 1 and 4 here. They're not correct because I know I've got year 10 down, right? It's either B or C. If I start to run into trouble with year 1, I've turned a 1 in 4 chance into a 50-50 chance of getting this right. Okay. Now I look at year 11. In year 11, the income was 410,000. So the numerator is not the issue in this question, is can I get the denominator right? So what happens? Well, I look and I have what? I have 200,000 shares of the stock that would have been from the split, right? The 100,000 times 2, that's that 200,000. And then they tell me that what? They went ahead and on April 1st, 20,000 shares of treasury stock were sold. And the stock split happened what? Happened July 1st. So I take what? That stock split retroactive to the treasury stock situation as well, right? And so I got to take that 20,000. I multiply that times 2. That gives me 40,000. So now I have what? 240,000. I take that 240,000 in the denominator, and that's where we get the 178. Okay, so the trick here was what? You've got to take those stock splits and you treat them what? Retroactively?
Question.
Uh,
For the extra 40,000 shares, wouldn't you actually have to calculate the number of months they were outstanding?
oh, yeah, sorry. Bad. Yes, you would. So, I'm sorry. So you take the 20,000, right? And you multiply that by the 2 to give you the 40,000. But then that was only what? That was only the case for 9 months, right? All of April, all of June, right? So that would be times what? 9/12. And that gives me what? 180,000. Let me rewrite this because I messed it up on both accounts. So the 200,000 was outstanding for what? 3/12. My bad. For 3/12. I was looking at the wrong thing here. For 3/12, that gives me what? 50,000. Okay, and then we take that 240,000. That's the 20,000. Do it this way. 20,000 times 2 gives me 40,000. That gives me 240,000. And then you're right, I multiply that times 9/12. That gives me what? That gives me 180,000. That 180,000 gives me 230,000. I take that 230 and I divide that into the 410, which was not a big deal for this question, the numerator. And that gives me the 178. Sorry about that. Okay, so we take the stock split back, but then they did issue additional treasury shares anyway at that point. So that's where that additional 40,000 came from, but we weighed it times the 9/12. Okay, good. Now diluted earnings per share. And we need to consider convertible securities. So we're going to need to consider convertible debt, and we're going to need to consider whether there are other items such as, you can see, options and warrants here. Okay, so we do not report anti-dilution. If something, anti-dilution means that it makes the earnings per share more than the basic, you don't report that. You only report things that make the earnings per share less than the basic. And you need to consider each item separately in order to determine whether it is anti-dilution or not, if it'll increase the earnings per share. Okay, so we would have income available to common shareholders, and then we would add interest on conversion of bonds, and we would do that net of tax. And then that is divided in a manner similar to what we just saw for the primary, the basic earnings per share by the weighted average number of shares. That would be very similar to what we just saw for the primary, the basic earnings per share. Now, let's look at options and warrants, okay? And options and warrants give the holder the right to purchase the stock of a company at a specific price over a specific period of time. To apply the if converted method to options and warrants, compare the exercise price to the average market price of the underlying stock. As long as the strike price is below the average market price, the impact is diluted, and the number of shares resulting from the assumed exercise will be added to the denominator in the earnings per share calculation. In other words, no one's going to exercise the option if what? If the strike price is more than the average market price, okay? But what's going to happen is we're going to be able to get some more money in when people exercise the option, and we pretend, this is one of the few times accountants get to pretend, we go and we pretend as though the options were exercised, we got more cash in, we immediately took that cash and did what? Repurchased our shares on the open market, but since we can't have enough money to repurchase all the shares that were issued on the exercise, it will be diluted and will be part of the calculation of the diluted earnings per share. Okay, so we take a look and we see in this example, a company sits here and they have what? They have 1,000 common stock options outstanding, and they can get 1 share of stock for each option, and they are exercisable at 30. The average market price is $50 per share when the options are therefore in the money and therefore dilutive. When the options are assumed to be exercised, the purpose of computing diluted earnings per share will be added to the denominator of the diluted earnings per share calculation. Now, we can actually use these numbers here to figure out that we have 1,000 shares, right? And we have 1,000 shares, and the option price is what? $30 per share. So that means the company's going to get an extra what? $30,000 in when these shares are exercised. Okay. And if the average price, they tell us, is $50 per share, well, that means that they can do what? That they can sit here and they can purchase an additional 600 shares. Not an additional, but they can purchase 600 of those shares back because they have $30,000 and the average market price is 50. And so what happens? If 1,000 shares got issued on the exercise of the option and I had enough money to go back and buy 600, then I'm going to add what? 400 shares to the denominator in calculating the diluted earnings per share? Question? Okay. Okay, good. Now let's go ahead and let's take a look at this one. And I'm going to give you a full 3 minutes for this question because it is multifaceted. How you like that for a word? Okay, so I'm going to go ahead and I'm going to give you a full 3 minutes. A question like this, I would highly expect would take you a full 6 minutes to full 3 minutes to answer this question. In fact, I'll give you 4 minutes, but on the exam, you shouldn't take more than 3. Okay, guys, we're at the 4 minute mark. Okay, so let's go ahead and let's take a look at this one. And couple of us got it right. 3 of us got it right. One of us missed it. And so this was a tough question, okay? And the reason it was hard is you had to what? Consider the potential anti-dilution of each element of this thing in order to know whether to include it in the final answer, which is the diluted earnings per share, okay? So the first thing you want to do is figure out, well, what is going to be the primary or the basic earnings per share. So they tell us that we had what, $1 million of net income, but we would have to subtract from that the what, the preferred dividend. So they tell us that there are 50,000 shares of convertible preferred stock. And they tell us that there was a dividend on the preferred stock of $2 per share. So if you have 50,000 times the $2 per share, that means the preferred dividends was what? 100,000. So that gives me 900,000. And I would go ahead and then divide that by the 200,000 shares of common stock. And that gives me a primary or basic earnings per share of 450. Now that serves as my benchmark. I sit there now and I have to look at each item and see if it is anti-dilutive. And as long as it's not anti-dilutive, then I'll include it in the dilutive. If any one is anti-dilutive, I kick it out. Okay, so I'm going to go ahead and do the preferred stock first. Now, what's interesting with the preferred stock, and an easy mistake to make would be to think that you add back the preferred dividend to the million. No, if I don't have the preferred stock, then I don't have to subtract off the preferred dividend, right? So the million is in the numerator, which is basically just my net income. And then they tell me that I can convert the convertible stock, the preferred stock can be converted into 40,000 shares of common stock. So that would mean that the denominator there would be what, 240,000, the 200,000 shares of common, plus the 40,000 shares of the preferred that would become common. So that's the 240. So that, when I do the math on that, becomes what? 417. So I know that the preferred stock is what? Is not anti-dilutive, and therefore will be part of my calculation of the diluted, right? Then I have to go ahead and I have to consider these bonds down here. Okay. Now they tell me that there were $2 million worth of bonds. Where is that? $2 million of 10% convertible bonds. Okay. And then they tell me that the bonds that were $1,000 each. So I take that 2 million, and if it's $1,000 per bond, that means that I have what? I have 2,000 bonds. And then they tell me that the bonds can be converted into 50 shares of common stock. So if that's the case, then I have 50 shares times the what? Times the 2,000 bonds, 50 shares. So that means that I'm potentially going to have what? 100,000 more shares of stock, plus the what? Plus the 200,000 shares. So that means that my denominator would become what? 300,000. Okay. But I have to figure out the numerator here now. And if my what? Net income was going to be 1 million. So I know that's there. But now I have to figure out, well, what's the interest savings? because I wouldn't have those bonds. So if they were $2 million bonds and it was what, 10%, but they tell me that the income tax rate is what, 30%. So net of tax, I'm just going to get to save what, 70% of that. And so when I do the math on all that, I get what, 140,000. Am I doing my math right on that? Okay, so I get to add that back to my $1 million, because I would have saved that net much interest net of tax. And when I do the math on that, I get what, 380? So that is what, not anti-dilutive. So now I can go ahead and calculate the answer, which is going to sit there and say, well, look, I have 100,000 more bonds. I mean, stock because of the bonds. Okay. I have the 240, which is what, the common stock plus the preferred stock. Right. So that makes my what? That makes my denominator 340,000. And my numerator is going to be what? The 1,140,000, because I wouldn't have had any more the preferred dividend. I would have saved that interest, right? And so when I go ahead and I do the calculation on that, now I come up with the correct answer, which is this 335. Now, I'm hoping the exam would not have these many layers to a question, but this is a good question for you to practice with, because it runs you through this idea. It reminds you that you have to consider each item separately to see if it's anti-dilutive. And if, as long as it's not anti-dilutive, then it gets included in the overall calculation. Okay. Okay, so I went through that stuff because you can see that's a little tricky, right? So I figured it was worthwhile spending some time with that. Now, coming over to topic section 2, topic A. Now, section 2, topic A is not as complicated, okay, as what something that we just looked at. But I want to spend some time with it because accounts receivable and the related allowance is a 10-point area on the exam. And allowance accounting is something that is pretty easy. But if you get confused, if you don't study it, if you don't look at it prior to the exam, then it becomes hard and we lose the opportunity for an easy 10 points. Okay. And so that's why I want to spend a little bit of time of this one, this with you. Okay. Now, the allowance for well, we're going to practice basically, because I don't know what the hell this is. I guess that's a T account. Okay, but what I'm going to use is BASE for these questions, which is what? Beginning balance. Then we have the adds, we have the subtracts, and we have the ending balance. Okay, and this is going to be key to answering account receivable questions, to answering allowance questions for us. Okay, so remember, we've talked about that. So with that, let's just go ahead and let's work a couple questions just to remind ourselves how to do this, because this is a 10-point area and I want to make sure that you've got it in your mind that this is something that you're going to be comfortable with on the exam. Okay, so I'm going to let you go ahead. I'm going to turn you loose on some of these. And for these, I really am just going to give you the 2 minutes. Okay, guys, I'm gonna go ahead because I have a feeling somebody's checked out here. And so you take a look, and I think everybody who's still participating got this right. Okay, so let's just go ahead and let's practice with this one. And so we have what? We have the accounts receivable, and they want the amount collected from customers. So I'm going to use BASE, and the amount that is collected from customers, of course, is going to be subtract from the accounts receivable. So that's what I'm looking for. So when you get a question like this, you just set it up as a fill in the blank. Okay, so I have what? Since they're asking me about year 3 here, okay, so year 3 information, right? So the beginning of year 3 is the end of year 2, right? So I know that the beginning balance is what? 175,000, okay? Excuse me, 150,000, right? And they tell me that the ending balance is 175. Now look, I put the information down as I get it. I don't have to sit there and wait. I can just put it in as I get it, right? You want to have a method, and that's part of why I'm doing this with you, even though you all got this right. It's the process to make sure that you're spending just the 2 minutes on a question like this. In fact, you should probably get this done, in which many of you did, all of you did, and less than that. Okay, now the company wrote off 40,000 of accounts receivable during the period. Well, if they sat there and they wrote off 40,000, then that's part of the subtract, isn't it? So I would just put that in as part of the subtract. And then they say that they had sales for 600,000 and all sales were on account. So that is going to be an add, isn't it? Now, the way I approach these is I give myself subtotals. Okay, so I'm going to write in subtotal here of what? 750. And then I'm going to give myself another subtotal here, which is what? Since this 40,000 was to subtract, what I do is I go and I add it back to the 175. And when I add it back to the 175, I get a subtotal here. So I can give myself a couple subtotals of 215. So the question becomes, well, how could you get from 750 to 215? So then when you subtracted another 40,000, you ended up down at 175. And the answer is what? I would have subtracted 535. That would have been the collection. That would have brought me down to what? That would have brought me down to 215. So that when I subtracted the 40, I ended up with 175. So I typically go ahead and give myself another side calculation here, which is I take the 750 from the 215. So to get to 215, I would have had to subtract what? The 535. And that's the correct answer to the question. The reason I do them like this, guys, is so that I do every question the same way using BASE. Because some questions might ask me the ending balance. Some questions might ask me what was the amount that was written off. Some question might ask me what was the sales for the period. And if you find yourself jumping around and doing every one of these questions differently without using the BASE, then you're opening yourself up to much more error. So I always set it up like this. Okay, good. Let's go ahead and let's do question 2 here. Okay, guys, we're coming up on 2 minutes here, and I think everyone who's still participating has got this one. And so let's go ahead and let's take a look at this. And most of us, let's see, most of us missed this one. Okay, so only one of us got this right. So let's work on this one a little bit together. Okay, so stop sharing. All right, share results. Only one person got it right. The answer is A, but let's just take a look at this one. Okay, so again, we use the BASE for this, okay? And they tell us that they report accounts receivable of 885, net of the allowance for doubtful accounts of 45,000. Now they're going to ask me year 3. So again, year 2's ending balance is year's 3 beginning balance. I put that in. That's 45,000. Then they want me to figure out, well, what is the bad debt expense? Well, if this is the allowance, that's the add to the bad debt expense, right? To the allowance, I should say. Bad debt expense is the add to the allowance. So that's the number I'm going to be looking for. Now they come over and they tell me that the balance sheet showed gross accounts receivable 922,000 in year 3. And Red Rock's income reported sales of 3 million. During the year, accounts receivable of 35,000 were written off. Well, that 35,000 that's written off is a subtract from the allowance, isn't it? Okay, so I can put that in. And 18,000 were recovered. Well, if 18,000 were recovered, that goes back into the allowance, right? We debit the accounts receivable and we credit the allowance. Allowance is increased by a credit. So I need to put that 18,000 back. Okay. And then past experience shows that 5% of the ending balance of account receivable is uncollectible. So if I have this 922,000 that is outstanding at the end of year 3, 922,000 times what? 0.05 means that they want to have as an ending balance there 46,000. So now I start to do my little subtotal trick, which is I go ahead and I say, well, 45,000, put that in red, 45,000 plus 18,000 gives me 63,000. That's a subtotal. And what? And before I had the write-off, I must have had what in there? 46,000 plus 35,000 gives me 81,100. Is that right? Or is it? Oh, this is 46,100. $46,100. Okay. And then when I add this up, I get 81,100. So we're saying that before I wrote off 35,000, I must have had 81,100. And before I added anything more, I had 63. How do I get from 63 to 81,100? I would have to add what? I would have to add 18,100 to get myself, which is the answer to the question, 18,100, to get myself to where I would have 81,100 so I could write off 35,000 to get to the 46. So again, I would have taken the 81, the side calculation would have been to take the 81,100, subtract the 63,000 from it, and that's how I get this 18,100 that was the correct answer to this question. Question? Okay, good. Now, inventory. So if you come to, I'm not going to deal with that factoring because I think that's relatively light and I'm looking at the time and I want to make sure we have time to get through some of these. Inventory, 10-point area on the exam. Okay. Now, when you look at inventory question, okay, there are 4 or 5 things that they want to know. It's 10 points. And you can really break these 10 points into 4 or 5 areas. One, they want to know specific items to include. 2, they want to know costs to include. 3, they want to know, can you handle perpetual versus periodic? And oh, I'm sorry, 3 really is valuation. 3 is valuation. 4 is perpetual versus periodic. And then I say 4 or 5 because the 5th is going to be the different inventory methods. And then they may ask you, well, what would be the answer if you were using FIFO for perpetual versus FIFO for periodic, LIFO for perpetual versus LIFO for periodic. So those last 2 could actually be combined into 1. Now, if we're talking about periodic, guys, I think you know by now you have to know this well. This is going to be a key thing. So make sure you are very, very comfortable with how to get the cost of goods sold using the periodic inventory formula, if you will. Okay. Now, goods in transit. If something is free on board shipping point, title passes when goods are shipped and in transit, and therefore would be what? Included in the purchaser's ending inventory and would be considered a sale and subtracted from the seller's ending inventory. If it is free on board destination, title passes when the goods are received. So what happens if goods are in transit? They are not included in the purchases ending inventory. They are included in what? The seller's ending inventory, and there's no sale. Okay. So that's really dealing with that first one, what items should be included. And so let's just go ahead and take a look at on the next page here, this question, see if we know what items to include, specific items to include in inventory. I'll give you 2 minutes if you need that. Okay, let's go ahead and let's take a look at this one. And the just about everybody got this one right. Everybody got this one right. Okay, so let's just go ahead and take a look though at what we needed to do with this. And they give me the inventory based on a physical count. Okay, so that was what's actually sitting there at the warehouse. That's 1,750,000. Now they give me some more information here. This is all distractor. Maybe it led into another question. I don't know. But then they want to know the inventory balance at December 31st, year one. And they say included in the physical count were tools billed to a customer free on board shipping point December 31st. The tools had a cost of 28,000, were billed at 35. The shipment was sitting on the loading dock at 5 p.m., waiting to be picked up by the common carrier. Well, they counted them, and they should have, because the terms were what? Free on board shipping point. Since they hadn't been shipped yet, they should still be included in the inventory, right? So I simply forget about that, right? I don't need to do anything for that. Then the goods were in transit from a vendor to Mixon on December 31st, year one. The invoice had a cost of 50,000, and the goods were shipped free on board shipping point on December 29th, year one. So those goods were in transit, but since they, even though they hadn't arrived yet, I have to include them in my inventory because it's free on board shipping point. So I add in that 50,000. That gives me the 1,800,000. Which everybody got. Okay. Okay, good. Let's take a look at the inventory valuation methods. Okay. Now, under US GAAP, the appropriate inventory valuation method can be applied to a single item, a category, or total inventory, provided that the method most clearly reflects periodic income. Now, I want you to put down that entire, actually, I'm saying that wrong. Individual items is most conservative. So let's say you're a clothing store and you have shirts and pants. Well, what happens? If you value your inventory, all the shirts, all the pants, what happens? There's not as much chance for them to cancel each other out. Whereas if you did it, say, by the entire inventory, some items go up, some items go down, so they would tend to cancel each other out, right? So when you do individual items, that's the most conservative. Now they tell us that inventory is valued at the lower of cost or market when using LIFO or the retail inventory method. Okay. They tell us that the cost is determined using appropriate inventory cost flow assumption. Market generally means current replacement cost, provided the current replacement cost does not exceed net realizable value, which is the market ceiling, or fall below net realizable value reduced by normal profit, which is the market floor. Now, when I told you when we went through this back in F4, you have to know the definition of ceiling and floor, or you're going to struggle with these, right? Okay. And then in all other cases, we simply use what? We simply use net realizable value. In other words, if we're using FIFO, anything other than LIFO or retail. Okay. So let's look at this question, and I'll give you a couple of minutes to look at this question now. How do we value the inventory under, and they're using lower cost or market for this, so it must be LIFO is the inventory method they're using. Okay, good. Minute 16, everyone's had a chance to look at this one. And okay, most of us got it right. The answer here is the first one. But let's just go ahead and take a look at this one together. Okay, we'll get questions like this. So we have what? We have the cost of this inventory is 26. And we want to see if the market is lower, then we're going to report it at the lower market. So we have to figure out, well, what is the selling price? Selling price is what? 30. The cost to complete and dispose is what? Is 2. So the net realizable value, or what? Market ceiling, is 28. Okay, now that's the ceiling, but then I have to figure out what? The floor, and the floor is going to take off a normal profit margin of 7. So that floor is 21. So I can't report the inventory below the floor. I can't report it above the ceiling. But since what? Since we're in a situation where the cost is fallen, the market is fallen below the cost, then I will report it at the floor. I'm capped at that floor, right, of 21. Okay, I'm not going to report it at 28 because the cost would be less than the 28. And I'm going to report it, and I can't report it below the floor. So I report it at the 21. Okay. Okay, good. Let's take a look. So we know how to value the inventory. Let's take a look at the inventory methods. And guys, on the exam, you may very well get a task-based simulation in which they're going to ask you to figure out cost of goods sold and or the ending inventory under FIFO, LIFO weighted average. That has long been a task-based simulation that they have asked us to look at. And you may need to know how to do that under periodic and perpetual, and or perpetual. Okay. Now, another method that we talk about a little bit is moving average. Okay. And with moving average, you calculate a new average price after each purchase. So notice that we sit here and we have this inventory, and then we purchase what? We purchased some more units, 200 more at $6. And so now the total cost of inventory is $1,700. And since we now have what? Now we have additional units. We have now what? The 100 plus the 200 gives me the 300. That's where that came from. Okay. We will now go ahead and calculate a new moving average by taking that 1,700. That's the 500 cost of the original plus the additional what? 1,200 that came in. That's where they get that 17. We will now calculate a new moving average of 567, and the next sale of inventory would go out at that 567, right? Okay. Now, dollar value LIFO. And with dollar value LIFO, they're going to make me calculate the index. Okay. Now, if they give me the index, I don't have to worry about it. I just use whatever index they give me. But more likely what they're going to do is make me sit here and figure out the price index. So if that's the case, then I have to go with what? Total ending inventory at current year dollars divided by total ending inventory at base year dollars. And they would have to give that to me in order for me to figure out whatever the index is so that I can value that new layer. So when you look at this one, notice guys, it's total. A common mistake is that candidates try to calculate the index based on the layer. Don't do it that way. It's based on what? The total, right? So they pick up the total. which is 90 divided by 60, gives me a layer of 3 seconds, I guess, or was that 1.5, whatever. Okay, and then what? Then I take that and then I figure out the layer at base year. I multiply it by 3 over 2 or 1.5. That gives me 15. And then I bring that what? I bring that 15,000 in, add that to the 50,000 to give me the answer here, which is 65,000 would be the inventory under dollar value LIFO. Okay, so the key takeaway here is calculated on what, and I had you flashcard that in the main part of the class, on the total. Don't calculate your index based on the layer. Common mistake that you should stay away from, obviously. Okay, all right, good. So with that, and I like that they did give us, and we're going to finish with a series of inventory questions. I want to go straight to these because I think this is good practice for you leading up to your exam. I'll give you 2 minutes for each of these, and that's going to pretty much wrap us up for tonight because I think we're all getting a little tired. So let's go ahead and let's take a look at this one. Okay, looks like everybody's had a chance to take a look at this one, and good. The answer here is D. Everybody got this, okay, but let's just take a look to see how we would have answered this question. And they tell me that I'm using FIFO, and they tell me that sales were 500 units, okay? And they want me to sit here and tell them what would be the value, what would be the cost of the inventory, of course, ignoring any lower cost or market calculations under FIFO, okay? So what happens? Well, to make up those 500 units under FIFO, I would first go with the what? The 150, right? Then I'd go with these December 7th amounts. And then I would go with what these December 14th amounts would have been sold. And when I do the math on that, I see that what there's at least 450 accounted for there, but they sold 500. So that means I have to do what? From that 300 that's sitting there in the last purchase, I have to what? Use up 50 of those, then would be sold. So I'd be left with what? 250, and I'd have these 250, and then they tell me that those were valued at what? Or a cost at 500 each. And so the answer is the 125. And, you know, I'm ignoring any lower cost or market considerations here because they didn't give me any information for that. Okay, good. Let's take a look at this next one. Looks like maybe the same information, but now in the exam may very well do this to you. But now they're asking us for LIFO. Okay, good. Looks like everyone's had a chance to take a look at this one, and everybody got it right. And so now if we're sitting here, the answer is did everybody get it right? Y'all said B, right? Okay, so let's just take a look at this one. And if they are using a LIFO and they sold 500 units, this one's pretty easy. That means those are gone and those are gone, aren't they? Okay, so now I've counted for my 500 sales. So now I just have to deal with the 150 that I'm assuming are left at 400. That gives me what, 44,000, I guess. And then we have what, these 100 from December 7th that cost 440. That's going to give me 60,000. Not 440, but what I do, mix my numbers up here. So it's 440 is what, the 100, and 400 is the 150. I think I got the right numbers. I just calculated wrong. What am I doing? So
I think you have the answers flipped.
400 at 150, right, is 60,000. And this is 44,000. Thank you. And so that gives me 104,000. Okay. Okay, good. Now, as I said, it could be a task-based simulation where they'll give you a set of facts and then ask you to do LIFO, FIFO, weighted average. So let's practice with weighted average on a multiple choice style question. Then we're going to be done. I'll give you 2 minutes. Okay, good. Looks like everyone's had a chance to look at this one, and we're going overtime here. So let's go ahead and take a look at this one. Everybody got it right. The answer here is C. And item 3 here, the third one down. Of course, on the exam, you just have radio dials, right, that you have to fill in. Okay, but let's just go ahead and let's take a look at how we would have done this for weighted average. So we have in the beginning inventory 150 items. Those are at what? 400 each. So we extend that out and I get 60,000 for that. And then I continue to extend out the rest of these. And so I get 44,000 for that one. The December 7th, I get 92,000 for the December 14th, and I get 150,000 for the December 29th. I add all of that up, and that gives me what? 346,000. And then I divide that by the total here, which is the 150 plus the 100 plus the 200 plus the 300, gives me 750. And so I go ahead and I divide the 346,000 by the 750, gives me a weighted average cost for this inventory. And I got 461.33. And then they tell me that, and the cost of inventory December 31st under the weighted average method. And I have to figure out, well, if I had 750 units available, and they tell me I sold what? 500, that means I still have 250 units in ending inventory. And so I go ahead and I take that times the 250 units that are still in ending inventory. And I came up with 115,333. Is that what you came up with? And the closest answer is 115. The exam does not do that. The exam is not going to have you doing that much of a rounding error. Okay, so whoever created this question got tired and couldn't make it work out perfect. I don't know why they just didn't put 115,333 or whatever, but anyway. Okay, now what if they asked me cost of goods sold? Cost of goods sold would be what? 500 times that number. Okay, so a good exercise for any question they ask you ending inventory is to also flip and say, well, what would it be for cost of goods sold? Because in my dream, they asked both the ending inventory and the cost of goods sold under the methods that were being talked about, under the information that was being talked about. And they could ask you both under perpetual, or they could ask you both perpetual and periodic. Okay, so, and I think we had some question like that in the regular course. So be ready with that. 10 points for inventory. The couple of things that I wasn't able to get to tonight, bonds, 10 points. Be ready for 10 points in bonds. Consolidations, 10 points. Okay. Revenue recognition, 10 points. You've heard me, what I've said about government and not-for-profit, right? Okay. So you start looking at some of these things: inventory, accounts receivable, bonds, consolidations, government. Okay. And I'm not telling you to ignore other things. You know, as a result of this, you got to know it all. I see it on Facebook all the time. So what parts can I ignore? Answer: none. Okay. But you do need to spend the requisite time, certainly with those that I talked about, revenue recognition as well. And then I really, really hope that you will be able to work through all of the final review questions in the software prior. I don't know that you need to read everything. Don't watch the lectures. You don't need to read everything, but you absolutely need to work the questions in the final review. And if you get stuck, go back to wherever the topic was, wherever that question was, and look up and read and do a quick review. Maybe you go back to the main textbook. Okay, I've done a lot of talking. Any question? Okay,
So-
guys. Oh, yeah.
Oh, sorry. I'm gonna skip that first class, but I'm probably gonna skip the second one too, which will be the actual first class in audit, and then I'll get caught back up.
Okay, that's fine. I will record that. So I think what we were talking about last time, hopefully you'll take your test before that third, whatever
Yep,
it is.
I'm taking it Wednesday, so.
That means you can watch that lecture for that half a chapter, you know, and be caught up by the time we're hitting the ground on that Thursday, right? Assuming
Yep.
you're not in a coma on Wednesday night.
Right.
That's my plan as well. I've got
Okay.
a similar timeline.
Yeah, I mean, I always tell the story when I took the exam. Because you had to take it over 2.5 day period. So half a day Wednesday, all day Thursday, all day Friday. And it was funny because I was fine until Friday. As I walked out of the exam, I got the worst headache I've had in memory. And I think it was just because the release, it was like, okay, the body said, okay, now we can suffer. Go ahead. You know, the adrenaline was flowing. So you may be a little zonked out, definitely after your exam, although it's only 4 hours for you only on that day, but you'll probably be a little zonked out. So if you can, you know, get to that first half of chapter 1 for the audit. Michael, for you, it'll be audit MBC, I think you said. So see what you can do to get through that first class audit on Wednesday. And then on the weekend, you can look at that first part of BEC, and then you should be pretty much caught up for when you hit the ground running that next week.
Sounds good.
Thank you.
Thank
Okay,
you.
guys. Good luck.
See you in a couple weeks.
All right.
Bye.
Bye.